Is now starting. All attendees are in listen-only mode.
Hi everyone, thank you very much for joining us today. I'm Emma Elliott and I'm a business tax manager based in our Reading office. I'd also like to introduce Brad McAvoy. Brad's a director in our corporate finance team and will be leading us through the webinar today. Today's webinar forms part 2 of a series we put together on the implications of succession planning and business disposals. Last month my colleagues Mark and Sharon talked through the key tax factors of succession planning, and today we'll be focusing on selling your business to third parties from a transactional perspective. I'll weigh in on some of the tax aspects of these as we go, and then after I'll spend some time talking through the key differences on a share versus trade sale for tax purposes and explore some of the pre-disposal opportunities that you might benefit from to maximise your post-tax consideration. Hopefully we'll provide you all with some good information to start some interesting discussions. So without further ado, I'll pass you over to Brad.
Thank you, Emma. Hi everyone, I'm Brad. You'll see on the screen now, these are the topics we're going to cover today. The first one, the method of selling your company that works best for you. Just a bit of context in terms of the variety of processes and things that you can potentially come across out there in terms of selling your business. The key areas of scrutiny which purchasers look for in your business, and the benefits of doing any sort of pre-sale due diligence process. How effective transaction support can help. How legitimate pre-tax sale planning can maximise your bottom line. And then obviously close with, what are the potential pitfalls of poor planning prior to sale. So the first point I wanted to make is that there are a variety of triggers for a business sale and a variety of methods and processes that are used in selling businesses. It may even not be a full sale. There could be a partial or phased exit, and Emma will cover the various tax implications of these scenarios later for you. However, key consideration for an owner-manager is what are your individual goals and aspirations, as any business sale should be well thought through in terms of what your goals are personally. The individual and business are clearly linked in your situation. For example, what are your value expectations? What is your preferred time frame for exiting the business? There will also likely be discussion during any sale as to a transitional period of involvement by the owner. Part of your goals and aspirations for any sale will be to consider how long you are willing to stay in the business post-sale. The triggers for a sale could also vary. It could be through an unsolicited approach from another party, such as a competitor, or it could be a formal sale process that you initiate when you decide. This is obviously ideal as it provides control of the sale process with you and gives you necessary time to prepare for that sale. The formal sale process could also vary between an auction-style process where a number of parties can make offers at once versus a one-on-one exclusivity arrangement where a preferred party is identified early to have exclusive negotiations. The motivations of buyers will also vary, which means their focus on what they are looking for in your business will be different. For example, private equity may be looking for short-term growth opportunities in your business so they can generate returns for their investors, while trade buyers may be looking for more strategic long-term synergies. Both buyer groups will have their advantages and disadvantages when you're looking at potential buyers for your business. You'll notice that the key recurring theme of this presentation today is that preparation is critical to any sale process, and don't underestimate how long adequate planning will take. In our experience, the most benefit to a successful sale is where preparation can commence at least 12 to 18 months before a sale process is started. This provides sufficient time to rectify any issues that could derail a transaction and provides the greatest opportunity to maximise sales value. Ultimately, selling your business is like selling a house. The more presentable, better managed and operated it can be shown to buyers with lower risk, then the more chance you will achieve the higher end of market value expectations. So what could happen if you are not adequately prepared? Well, the deal could fall over. It could waste a lot of time, cost and effort on your behalf. It's a very stressful situation going through a sale process. It can be very emotionally draining. So having a failed process at the end of it with nothing to show is quite emotionally draining. There could be price reductions. Buyers could propose reductions in their initial offer price if unforeseen issues are identified. There could be entire time delays with the sale. It could just drag on and on longer than what you're hoping for. And warranties and indemnities provided in a sale and purchase agreement may be overly onerous, and there may be an increased risk of future claims against you. So what are the key areas of scrutiny for purchasers? Well, any sale journey you go through will always be subject to due diligence from buyers. This is an intensive period of investigation from buyers to make sure that the price they're offering is for what they're expecting and there are no unknown risks or issues with the business, which would either mean a reduced price or even create such uncertainty that they could walk away. Every due diligence process is an intensive and stressful time for the owner, as typically the information requested from buyers and responses to questions will need to be provided by the owner or a lean management team, so there are typically resource challenges in being able to deliver information on a timely basis while also still running the day-to-day of your business. Especially considering that there will be a number of parallel due diligence streams all wanting information at once, such as commercial, technical, due diligence, financial, tax and legal. And as accountants, our specialty at James Cooper Creston is obviously on the financial and tax due diligence side, myself on the financial and Emma on the tax, and this is something we get involved in every day.
Yeah, from a tax perspective, buyers are aiming to identify any areas of risk that they might be exposed to post-acquisition, and it's worth noting that these generally apply on company sales, as buyers don't inherit the history in most cases on an asset deal. From experience, most buyers look closely at employment-related tax issues. Often in owner-managed businesses, payroll and benefits returns are undertaken in-house, and even with the best care and attention, with the changes in tax legislation, there's scope for error. For example, following the recent changes to employee benefit and salary sacrifice rules, acquirers are going to be looking really closely at the returns for transitional periods to look for any exposure that might arise there. Another area that I've seen come up against scrutiny again and again is payments to self-employed individuals, as the company can be exposed if it engages someone to perform functions for the business and HMRC can demonstrate that they are in fact employees. The company can be required to operate PAYE, which can result in payments being grossed up, and it creates a real cost to the company, as interest and penalties can apply in these situations as well. From a practical perspective, I've actually been involved in a transaction where this was picked up on diligence, and as a result the sellers were forced to accept a smaller consideration to cover the costs of putting things right. I think whether or not an individual is an employee is often an employment law point, but I've seen several instances where this has been picked up initially through tax diligence, so something to be aware of. Again, that's often an area where businesses manage their own filings, but keeping up with the rules can be difficult, and especially where businesses are growing quickly and their activities become more complex, mistakes are often identified, so people tend to look closely at these too.
And just touching on the financial due diligence side of things, this is an example of some of the areas in our experience that we tend to cover in our due diligence exercise. And buyers will be focused on different things, but this just is a broad snapshot of the key areas that they tend to focus on. Buyers will want comfort around the integrity of financial information and basic controls and reconciliations, even basic things such as, do management accounts agree to your year-end statutory accounts? Quality of earnings can be quite a subjective area and relates to identification of any items regarded as one-off or abnormal to earnings. So manual adjustments a buyer may make to your earnings because they don't view it as being sustainable. Due diligence looks at understanding what has generated financial performance, looks at revenue profile, seasonality, margins by customer and product, also an analysis of expenses and employee costs. It really can be quite a detailed exercise in terms of information and analysis that is required. Also, the forecast will be critically analysed in some detail, so it's important that the seller has a robust forecast developed with logical basis for key forecast assumptions. The more believable and supportable the forecast is, then the more buyers will be willing to pay for any forecast upside. Working capital is the trading assets and liabilities of the business, which are readily converted to cash, such as your trade debtors, stock and trade creditors. Buyers will want to ensure a normal level of working capital is left in the business on completion, and this is typically an area of debate as to what a normal level is. Buyers will also typically take any debt in the business straight off the headline price or enterprise value of the business. And there is also some subjectivity in what is defined as debt, so be ready for these questions from a potential purchaser. These questions here are just some initial considerations that you can ask yourself when you are thinking about starting your preparations for a sale process. Is there a clear business strategy? What is your view on where your growth is coming from? What are the markets? What regions? What customers, etc.? This growth story needs to be sold to potential buyers and will form the basis of any information memorandum or marketing documentation that will go out to potential purchasers. Are employee contracts formalised, as are customer and supplier arrangements? In general, the more formal the arrangements, the more certain and bankable they are for a buyer. Is the corporate structure something that is attractive for how a new buyer will want to acquire? Particularly tax considerations play a part here, which Emma will touch on shortly. Are there upside opportunities in the business which can be valued and supported? And finally, is financial reporting of a sufficient quality to provide the insight and analysis required in a due diligence? For example, monthly management accounts, including profit and loss and balance sheets, are a minimum. Also ensuring that those profit and loss and balance sheets have proper accounting processes such as cut-off and accruals on a monthly basis. Final two questions here. What are the general risks of the business? How are these mitigated or managed? Are there sufficient internal controls and management oversight over key operations? Are IT systems sufficient for a business of this nature? Are there resources available that can be dedicated to a sale process? Many times, and we see it very often, that owners want to keep a potential sale confidential from the rest of the staff, so as not to distract them initially. But we would recommend that key members of the management team are briefed early so they can get involved in the preparation and due diligence process. It is quite an intensive exercise, and having a few key people involved in that process early and assisting along the way will definitely speed the process up in the long run. So now we're looking at how transaction support can help as part of your preparation process. So why would you need transaction support? Well, the shorter answer is that as an owner of a business, you don't want to go through a sale process every day. So it's best to take advice from professionals who are specialised in this work. You want to achieve the best result financially and commercially, so transaction support advisors can give you guidance on what you should focus on, both from a business and tax perspective.
Yeah, I'd always recommend getting support from a tax perspective early on, just to understand the implications of any historic planning that might have been undertaken and how the current group structure might affect a sale. To give you some examples, I've acted for buyers where they became aware of some tax planning which was popular for a while, which in the end concerned them so much that they walked away from the company and from the deal, even though the sellers weren't actually yet under inquiry themselves. I think if they'd unwound planning in advance, there could have been a successful sale, Dave, and I've seen instances where sellers have been willing to accept offers with earn-outs, which isn't uncommon at all, but by making our client aware of the various different outcomes of each option, we were able to help them structure the deal so that they received the right mix of consideration and that they got it at the right time, so that in the end they didn't pay any more tax than would have arisen if they'd received it all up front.
Yeah, so transaction advisors can also give you guidance on what you should be expecting for the sale price and assist in negotiations on your behalf. There's also the advantage of freeing up your time by project managing the sale process and being your arms and legs and compiling information for a data room and responding to due diligence requests. There are various options you can use transaction support in your preparation process. You could perform a thorough pre-sale due diligence and tax health check to identify any issues that need to be resolved. But it also has an option, and as an initial more cost-effective first step, you could also have an initial business diagnostic performed to see where you should focus your efforts. This is an example here of a service offering we provide at James Cooper Creston. It's a high-level scan or diagnostic of a business that we call a business sale readiness assessment. The aim here is that we perform this diagnostic 12 to 18 months before you start a sale process, so you can develop a practical action plan to address the critical needs of a business which could cause issues for a buyer in a sale process. It is a high-level 2 to 3 week process involving interviews with management and review of some key documentation covering over 100 assessment areas. It uses our experience to benchmark your business against what buyers would expect for a business of your size and nature. And we are very aware that one size does not fit all, so all our recommendations and action plans will be tailored based on your individual business. This is just examples of the 8 broad areas we cover as part of that assessment, and within each of these areas there are a number of subcategories. The aim is to provide a holistic view of the entire business, and you have a really clear idea across the business on what needs to be done. I won't go through this in much detail here, but if anyone does want any further information, then feel free to contact me and we'll have our details at the end of the presentation we'll provide you. The outcome of our review then is a prioritised matrix of action, similar to what it looks like here, which is based on the importance both to value and the transaction process versus the length of time required to perform the actions. So behind each of these little bubbles on this graph here is in action with a detailed plan and recommended course of what needs to be done, timeframes and responsibilities. This focuses management on high priority items in the limited time available before starting a sale process. So it just really gives focus and priorities, and at the end of the day, tries to give you more bang for your buck based on how long you've got before you want to initiate the sale process and where you want to get to from a value maximisation point of view. Now that we've looked at the different ways of structuring a deal, I'll pass you over to Emma, who will talk about some of the tax consequences and opportunities.
Thanks, Brad. One of the biggest costs of selling your company or business is paying the tax bill, so it's important to make sure that an understanding of the tax consequences run alongside the commercial discussions from the early stages. Over the next few slides, I'll talk through some of the high-level tax issues that arise to our disposal and some of the potential outcomes. I'll also explain a little bit more about the rules for entrepreneurs relief following changes announced in the budget, and then after that we can discuss how best to get your proverbial ducks in a row and we can take some questions. So, on a very high level, the proceeds that you receive on the sale of your company will be subject to capital gains tax. As a brief overview, the main rate of CGT for higher rate taxpayers is 20% and 10% if your gains fall within the basic rate band. There's some additional rates where trusts or residential properties are involved, but let's stick with the capital gains tax liabilities that we would expect for a trading company, as I think that's what most of you probably operate within. An annual exemption allowance of 11,700 applies for gains in 1819, but on the assumption that you're selling a very profitable business, it's unlikely to make much of a difference to your overall liability. For those whose businesses and shares meet the conditions, entrepreneurs relief is available to reduce the tax rate on qualifying business disposals to 10%, and that's regardless of your other income. The relief applies to the first 10 million of a person's gains, so there's a potential tax benefit of up to £1 million up for grabs. For companies that sell the trading assets of a business rather than the shareholders selling the sales, there's typically chargeable gains that are chargeable to corporation tax, which is currently 19% and due to fall to 17% in 2020, which I'll talk through in an example later. So once you've decided that you want to sell your business for tax, it's important to consider whether it's the trading assets of your company that you're going to sell or the shares in your company. Buyers sometimes prefer to buy the trading assets so that they don't acquire the company's history, but generally owners prefer a clean break and to sell the shares. A major benefit of that for you is that you avoid potentially paying tax twice. To give you an example, if you sold the whole of the trading assets of your business, your company generally would pay corporation tax on the receipt. To then extract the residual funds from the company, you potentially then have to pay tax again, and depending on what your future plans are, you could end up declaring a dividend and paying tax at 38.1%, which is the highest rate currently, whereas if you can negotiate with the buyer to buy the shares as a shareholder, you'd expect the only tax charge to arise to be the capital gains tax you pay as an individual, which, as I said before, could be as low as 10%. It's not to say that you can't negotiate and play with the number so that you reach a number or a method that works for both the buyer and the seller, but a strong team supporting you and explaining these things as you go undoubtedly helps in the negotiations. On this slide, I put some numbers on what I've outlined based on a very simplistic scenario with some sweeping assumptions, mainly that entrepreneurs relief is available on all capital gains tax disposals and that the buyer is willing to pay the same price under each scenario. So let's look at the first scenario here, the sale of the shares. This scenario gives the lowest tax liability by a significant margin at £1 million. Even without entrepreneurs relief, the capital gains tax liability at 20% is still much lower than the next best option. If we look at column 2 next, this assumes that an asset deal has been reached and that all of the proceeds are attributable to something with no base cost, for example, internally generated goodwill. The company will pay corporation tax of 1.9 million, leaving 8.1 of income in the company, assuming the pre-disposal assets and liabilities have effectively cancelled one another out. A potential option to attract capital treatment on the 8.1 million would be to liquidate the company and then claim entrepreneurs relief, and there are conditions that you have to meet to do that, but assuming the conditions are met, that would give rise to overall tax of 2.8 million, so much higher than the sale of shares that I looked at in scenario 1. I've modelled scenario 3 on the assumptions of column 2, but with the difference that entrepreneurs relief isn't available on your disposal and that capital treatment isn't available either. The situations that could arise on would generally be if the circumstances of the disposal fell within certain anti-avoidance provisions. In this case, a shareholder could be treated as receiving a dividend which gives rise to tax in the region of almost £5 million, which you can see down the bottom, so quite eye-watering. Given how beneficial entrepreneur's relief is, I'll have a quick skip through some of the rules and conditions that shareholders, companies and shares need to meet to qualify. Entrepreneur's relief can apply to the sale of an unincorporated business and some business assets as well as sales. So for example, if you held a trading property outside of your business, that could also fall within this too. Following announcements made at the budget, there are 4 qualifying conditions for the relief to apply, which on the face of it appears quite simple, but there's plenty of detailed legislation underpinning these with some complex interactions with other rules, and it's not possible for me to cover everything in detail today, but I'll look at some of the major points. Currently, the first 3 conditions must be met throughout the 12 months finishing on the date that the shares are disposed of, but at the budget it was announced that for disposals made on or after the 1st of April 2019 that the minimum holding period will increase to 2 years. I think it was widely expected that changes to entrepreneurs' relief were afoot, and I think the general feeling is that the majority of straightforward transactions won't be affected by this particular rule. So the first condition is that the individual disposing of the shares must be either an employee or an office holder of the company whose shares are being disposed of. For many owner-managed businesses, the shareholders are directors who actively participate in the running of the company, although we often see spouses or family members who own shares who maybe don't have an active role in the company, so it's worth bearing this condition in mind if you're disposing of shares and hoping for spouses or family members to qualify for relief, and I'll talk a wee bit more about that later. The next qualifying condition is worth highlighting that owning 5% of the issued share capital of a company won't necessarily be enough to qualify for entrepreneurs' relief. Individuals also need to own 5% of the voting rights in the company, which might not be the case if there are any non-voting shares in issue. These rules have been in place for a long time and have been carefully considered when putting companies together, but what did also change in the budget is there's now been an additional condition introduced that, in addition to the rules that I've just gone through, the shares must also now carry 5% rights to participate in dividends and of the company's assets and are winding up. Clearly, a careful look at your articles is a good idea at the moment to assess whether any of your shareholders may have been caught out with this, where there's more than one class of share in issue. Some private companies do use different classes of share to stream dividends, and there are some concerns that changes made in the budget mean that some of these arrangements no longer work. We understand that HMRC's intention wasn't to catch the sort of shareholdings I've described, but until further guidance is published, we can't say anything for certain. The final condition is an area that we often come across in practice, and I'll talk in a little more detail about what constitutes a trading company. So trading companies also encompass trading groups for these purposes, and when HMRC look at the activities, they look at the activities of the group as a whole. The definition of a trading company is a company carrying on trading activities whose activities do not include to a substantial extent activities other than trading activities. So generally, HMRC takes substantial to mean more than 20%, and they base that on a number of criteria. HMRC have said that failing one test wouldn't necessarily mean that the company wouldn't qualify, and that they'll always look at things in the round. They would typically look at things like how heavily weighted the profits are in relation to the company's income. They'd have a look at assets and how much time management spends looking after a company or group's non-trading activities. Mark covered this in quite a lot of detail in our last webinar, but I'd be happy to talk through entrepreneurs' relief in more detail with anyone, so if you would like to talk this through, then please don't hesitate to get in touch. As Brad spoke about earlier, you might accept terms whereby some of the consideration is deferred or where you make a partial exit. On a full exit, it might be the case that the consideration received later won't qualify for entrepreneurs' relief because the conditions aren't met any longer, and in some cases it's possible to make elections to lock in the entrepreneurs' relief, although it may mean paying tax on money you haven't yet received or that may not be guaranteed. On partial exits, especially with private equity sales, it's far less likely now that entrepreneurs' relief will be available post-sale, as quite often the shares are structured in such a way that this won't work, and so understanding the differences in these areas will become really important. So what can you do to maximise value? I've listed some of the things that might help in maximising value in your sale. I mentioned before that shareholders who aren't currently employees or officers are potentially going to lose out on entrepreneurs' relief, so this is something that's relatively straightforward that could make a difference. I'd highlight that HMRC are very clear that the rule should be more than in name only, and whilst they don't consider that there are any minimum hours or salary requirements to an employment, that there should be some substance behind it. And I think Mark also discussed last time that there are some legal points to consider too around minimum wages and pensions, etc. You might choose not to take any excessive salaries or dividends in that final period in order to benefit as much as possible from the capital treatment. It's important to stay sensible in this. Obviously, you still need money to live and demonstrate that you're not just building up substantial cash balances in the company, but I think it's not unreasonable in those final stages to keep these to a minimum. Again, if you know you're coming up to a sale, you might want to make some contributions into pension schemes to maximise the tax benefits of those. You might want to consider giving some of your shares to family members if the gain is such that you're going to breach the £10 million lifetime limit. You might consider bringing children or spouses in, but again, they would need a genuine role in the company. And I think we've seen HMRC opening more and more inquiries into claims for entrepreneurs relief, so it's important to look at it closely. It isn't impossible to implement by any means, and if the planning is undertaken far enough in advance and you're happy for them to carry rights on the voting and dividends and assets, etc. that I talked about, then they may well qualify for entrepreneurs relief too. If you did make some gifts, you might want to look at whether gift relief would be available so that the transfer of shares wouldn't create a tax liability for you up front. If you're thinking of moving on to another venture, it might be possible to roll some of the gain into the purchase of new assets to defer the tax to a later date, but this might prevent your entrepreneurs relief though, so please do take specific advice if you're thinking of anything like this. If you wanted some of your employees to benefit from the sale, it might be possible to implement an Emi scheme if your company qualifies. These schemes operate in such a way that would allow the company to grant options to employees for them to acquire shares under agreed situations. So if your employee exercised their shares in an exit situation and the EMI conditions were met, and these are slightly different to those for entrepreneurs relief, then they might get entrepreneurs relief too. And there's an additional benefit for the company as well, because where companies have granted options or given shares at a discount, the company might qualify for an additional corporation tax deduction, which could boost your sale price even further. So that could be really valuable. As a note of caution, EMI schemes have to be implemented with care, as there's quite a lot of detail behind the rules and the admin has to be handled quite carefully. So I strongly recommend that you take specific advice. You could undertake a review of claims that your company's made to check whether anything else is applicable that might enhance the value of your company. For example, there were changes to legislation over recent years that's meant that if your company is disposing of a property, the purchaser could only claim capital allowances if you'd already pooled the assets in your company. So maximising any available allowances like that would make your property more valuable. You can take some time to consider the balance of activities that are undertaken by your company. If your company or your group does have substantial non-trading activities that I spoke about earlier, then it might be that planning can be undertaken to improve the entrepreneur's relief position. And one of the most common things I come across is investment properties that have been acquired through trading companies, and transferring the investment property business out of the company or group now by undertaking a demerger could mean that entrepreneur's relief is preserved in your trading company. Or you might have developed two trades over time that are just simply a little bit different, and by demerging the trading activities now, you might end up better placed for a share sale in the future as your trades have already been separated. Demerging companies is very complicated though, and it can result in tax liabilities, but if it's structured properly and it's for the right commercial reasons, then these can be minimised or mitigated altogether.
Right, so just coming towards the end of our presentation, yes, in summary, it's all about getting your house in order. If you're thinking, even contemplating a sale process, even if it's not tomorrow, if it's not next year, but 18 months away, as we suggest in our presentation, preparation is critical, and it's critical to get the best outcome for you. Consider obtaining some advice on whether a pre-sale due diligence review or assessment will assist in prioritising your time to focus on how you can achieve the best outcome. Find the right advisors as well. You will need experienced legal, financial and tax advisors along the way. So it definitely is a benefit getting advisors who are very experienced in these sorts of processes.
Yeah, you can look at health checks as well. A lot of companies regularly undertake these for VAT and PAYE just to make sure that they're staying compliant and that they're covering everything that needs to be done. But I think if you are considering coming up to a sale point, then it could be a real value of having a look at things like that.
Yeah, great. Perhaps as closing, we wanted to just pose a poll question to everyone. As I mentioned earlier in the presentation, there are a lot of motivations for an owner-managed business wanting to go through a sale process. I'd be interested just to get your take on where you think what would be the most important decision point for you in undertaking a sale process, and who you're deciding the appropriate buyer would be. Would your preferred outcome be achieving the best price possible, getting the deal done as quickly as possible, finding the buyer with the best cultural fit for the staff, or other commercial terms of the deal? This could be anything from the extent of warranties or indemnities, or the employment arrangements for yourself post-transaction. So very much we're seeing the results come through now, and very much top of the list is achieving the best price possible, or what have we got, 80% achieving the best price possible. It's quite interesting because many times owner-managed businesses have such an emotional attachment to the business that they don't want to just give it to anybody. There is very much, they want the right fit for particularly the staff and the business that they've, spent, in some cases, a lifetime building up. But interesting. I don't know what to say with that sort of result, but that's very interesting to know. Yeah, exactly right. Look, these are our contact details for myself and Emma. We will email the presentation to anyone who wants a copy. And unfortunately, we don't have time. There are some questions that have come through. Unfortunately, we don't have time to go through those today, but we're happy to sort of respond to those on email as well. But feel free, any questions from the presentation, feel free to contact us. That's great. Well, thanks very much for everyone's time today. It's been a pleasure.